Morning, Anuj. It's difficult to say at this point, but you've had a 1600-point decline on the Nifty one way and in a very short span of time in just about one series. So 11,800 back down to 10,200. That's a very, very serious fall. So it's conceivable that the market tries to form a bit of a range for a while. 10,200 might hold as a base for the moment. But I'm not brave enough to say that we've made a final bottom and markets are about to rally or strong enough to rally from here on significantly. We might have pullback rallies. I'm calling this a bear market, so bear markets have strong rallies. We could get up to 10,700, 800 kind of levels if global markets are supportive. But eventually, I think we'll probably have to contend with more weakness once the first part of the earnings season is out of the way. I think the macros are still very tricky. Sentiment is very poor. Global market timings are not great, and liquidity is very tight. So all of this makes the journey for equities quite tough over the next few months.
Okay, bear market. And you explained that very crisply then. But, last time around when the U.S. started hiking rates, it was the Fed's stamp over U.S. growth, and therefore it was taken positively. I mean, the big 2003 rally is what I'm referring to. Do you think that we will be able to overcome this bond yield increase at all and move on because U.S. growth is so good?
It's not the only factor, Lata, and that's the point. There are many other irritants in the soup right now. It's just not a U.S. bond market play. It's a very important factor, but not the most important factor. In fact, I would say that the 1600-point fall in the Indian Nifty has very little to do with the U.S. bond yield going up. There were other factors. There's crude. There is our local macro. There's politics. I mean, there's so many negative tidings at this point in time. In my book, the best case scenario for the market over the next few months is to try and work with some kind of a range of consolidation and hope that we can bounce back in a few months from now. No, I'm not very gung-ho about the market right now despite the price fall. I take the point about Anuj's question about much of the price damage being done, and I think in many of the mid-caps, maybe that could be true. But you know how these markets are. I mean, they can compress valuations more than you think. So for the moment, the price damage might be done, but I worry more about the large caps, which haven't fallen that much, at least in some pockets. So there could still be some damage left, particularly if the global selling continues in the large caps. It's all a bit up in the air right now. The best one can say is that one big leg of the fall has happened. A significant amount of price damage has already taken place, and therefore you would say that the chances of the market doing some bit of mean reversion in the near term have gone up significantly.
Udayan, good morning. One anchor that was supporting the market over the last 6 to 12 months was the whole consumption piece. And we're seeing a big slowdown there as well. I mean, auto stocks like Maruti, Hero, all down 24-25% this year. HUL has reported numbers. Of course, the 10% volume growth was good, but it could have been better is what the street was expecting at least. Would you use this as an opportunity to buy into any of the large cap market leaders, or is this a pocket to stay away from for the time being?
The problem, Sonia, is not so much the numbers. The problem is the valuations. And valuations are suffering from a market scare right now. At another time, maybe 4 or 5 months back or at the start of the year, if you were to present the market with a 10% volume growth for HUL, there would be raptures. There would be singing on the streets. But right now, when you give them 10%, they say, but it's a 50 PE stock. Should we be buying it right now? The orientation of the market has changed, and that is the most critical thing. The sentiment is not the same, and sentiment is very important for PE multiples.